Hello everyone, my name is Chen Xiang. I will talk about the last of part 1 and the whole of part 2. And my partner Fang Yining will talk about the first of part 1 and the whole of part 3.
Then I will talk about the part 1 bond duration. Question 1. The relationship between duration and the coupon rate. The higher the coupon rate is, the shorter the duration is. When the coupon rate rises, the cash flow of bond will be larger and earlier, resulting in the decrease in duration. A relationship between modified duration and coupon rates. The modified duration varies in the same direction as the duration, but the value is slightly lower. The higher the coupon rate is, the shorter the modified duration will be. The impact of the bond price is the lower coupon rate leads to the discount of the bonds, and the duration is close to the maturity time. High coupon rates lead to the bond premiums and significantly shorten the duration. Investment significance is if investors wish to reduce interest rate risks, they should choose the high coupon bonds. If investors were seeking long-term returns from price fluctuations, this is more suitable to choose my low coupon or zero coupon bonds. Then the question 2, the duration and the relationship. one 整段垮掉。And question 2, the relationship between duration and maturity. Maturity increases, duration grows, but the growth rate gradually slows down. It's a non-linear growth. When maturity increases, the critical repayment the time of bonds becomes later, the duration increases. Modified duration and the maturity relation. The longer the maturity period and the longer the modified duration, the higher the sensitivity of the bond to changes in interest rate. The investment significance shows the duration of long-term bonds is significantly longer than that of short-term bonds, and the interest rate risk is greater. Short-term bonds have short durations and small price fluctuations, making them more suitable for conservative investors.
Part 1, Question 3, the bond duration. The relationship between duration and the market-wide interest rate. The higher the market-wide interest rate is, the lower the duration is, but the decrease is smaller and the less sensitive the bond is to change the interest rate. The higher the market interest rate is, and the smaller the discount of forward cash flow is, shortening the weighted average time of cash flow. However, the stability of coupon payments partially offsets this effect, resulting in a smaller decline. The relationship between modified duration and the market-wide interest rate. The modified duration changes in the small direction is the duration, but the reduction is more significant. The higher the market-wide interest rate is, the lower the modified duration is. When the market-wide interest rate rose, the duration decreased. Correcting in the duration, the monetary amplifies the influence of the market interest rate. The impact of bond price. Low market interest rate lead to bond premiums and longer durations. High market interest rates lead to bond discount with the shortened duration. Investment significance. When market interest rate rise, bond price falls, but the shortened duration in a high interest rate environment will partially offset price fluctuations. The decline in modified duration is more obvious, and the plastic of bond price to changes in the interest rate decrease. Part 1, Question 4, the relationship between duration and the bond price. When the bond price rises, the corresponding market interest rate drop and the duration increase. When market interest rate decline, the discounting of future cash flow is slow, and the weighting of forward cash flow increase, resulting in a longer average weighted monetary time. The relationship between modified duration and the bond price. The bond price rises and the market interest rate drops. The denominator becomes smaller and the modified duration increase. The bond price is relatively high and sensitive to changes in the interest rate increases. Investment significance. Premium bonds. They have high price, high duration, and modified duration, and high interest rate risks. They are suitable for an environment where interest rates are expected to decline. Discount bonds. They have low price, relatively low duration indicators, and strong resistance to interest rate risk, making them suitable for allocation during upward interest rate cycle. Hedging strategies. Be combining the relationship between the bond price and duration. High-priced bonds need to hedge against interest rate risks over a long period. Part 2. Macroeconomics and the business cycle. First, the starting point of a recession is the peak of economic activities, and the end point, the trough. The recession period is the entire period from the peak to the trough. The NBER defines a recession as a significant decline in economic activity across the entire economy that persists for several months and is typically reflected in economic indicators such as the real GDP, real income, and employment. The recession period is usually the time between the peak and the trough. The NBER classifies the trough months at least 1 month of the recession period. NBER's judgment on recession is based on the synthesis of multiple data points. It reflects whether the decline in economic activity is significant. Duration. The duration of the decline in economic activities. Diffusions. Does it affect multiple sectors of the economy? Question 2. The longest expansion in June 2009 to February 2020. The duration is approximately in 10 years and 8 months. The background. After the economic crisis ended in 2008, the economy recovered. During this period, the sustainable economic growth led to a continuous decline in unemployment rate, and both consumption and interest activities showed an upward trend. Due to the impact brought by COVID-19 pandemic, economic expansion began to the end of in earlier of 2020. About the longest contraction in October 1873 to March in 1879. The duration is approximately in 5 years and 5 months. About the background. In 1973, the United States experienced excessive economic speculation and overdeveloped railway constructions, which led to the bursting of the bubble and triggered economic crisis. In September, the United States fell into deflation and bank panic, with a large number of banks and companies failing. When finance institutions were unable to continue providing support, the railway industry collapsed and came to a standstill, triggering a series of economic recessions and unemployment. Question 3. The NBER usually makes official announcements several months to nearly a year or even longer after economic peak or trough occurs. There are some specific examples. About the significance of investors. First, it reduced the value of immediate decision-making. NBER confirmed that it would take a long time to announce the economic turning point, so these announcements lack forward-looking for investors. Second, investors should rely more on leading economic indicators to determine the economic inflection point. Third, the announcement of NBER was used as a retrospective confirmation tool to analyze the relationship between the economic cycle and investment performance. Fourth, lagging indicators are applicable to strategic analysis rather than current operations. NBER data can be used for long-term economic research and backtesting investment models, but it is not suitable for short-term buying and selling decisions. For investors, they should rely more on leading indicator and market dynamics.
Then I will talk about the part 3, the limitation of diversification. Question 1, portfolio diversification is achieved by spreading funds across different assets, industries, or regions to reduce non-systematic risks. The main method is following. First of all, diversification of asset classes, industries, and regions. Secondly, group assets with low or negative correlations together to offset their poor performance. Thirdly, diversified investment styles. Fourth, diversified investment time and distribution. Last but not least, set a reasonable assets investment allocation ratio and manage the risk exposure of investment portfolio. The constraints of the international diversity, currency risk, political and regulatory risks, information asymmetry and transparency, market access is restricted. And lastly, the limitation of diversification, liquidity crush, scattered resources. A crisis in one region or industries can spread rapidly to other regions or industries, and the crisis spreads globally. High correlation among assets during a market-wide crisis, it cannot reduce systematic risks in the market. And question 2, firstly, I will select the stock market index Dow Jones and 3 companion stocks, Apple, Goldman Sachs, Amazon. And then find in the investing column Dow Jones Index, the share price and trend data of common stocks of the 3 companies from 2006 to 2010 and from 2018 to 2022. Through this data, the standard deviations were calculated prospectively by the standard deviation sample functions. Then I will draw the line graphs of the 2 methods to observe the changing trades. Among the During the global financial crisis 2006-2010, the year 2008 was the most survived year of the global financial crisis. The standard diversification is all stocks rises significantly and individual stocks fractionally. The standard diversification is Dow Jones Index rise to 5.17%, which was much lower than the individual stocks, indicating that the effect of diversifying in investment during a crisis was limited. In 2009, the standard diversification of the Dow Jones Index peaked. The peak of volatility lagged behind the peak of the crisis, resulting in a higher standard diversification during the repeated fluctuations in 2009. The period from 2009 to 2010 was a global economic recovery period. The volatility of the individual stocks was declined somewhat, but is still higher than the level before the crisis, indicating that the markets need some time to recover. The overall trade is the volatility of the individual stocks rises in tandem with the Dow Jones Index with enhanced correlation, resulting in a reduction in diversified returns. COVID-19, 2018 to 2022. The year 2020 was the year when the COVID-19 pandemic occurred. The standard deviation of the Dow Jones Index rise to 7.78%. Then the volatility of individual stocks was increased significantly at the same time, indicating that limited effect of diversified investment. In 2021 to 2022, the volatility of markets still have not subsided. In 2022, volatility intensified due to the rebound of inflation and interest rate high expectation index, as well as the standard diversification of individual stocks. Compared with the global financial crisis, increase in volatility during the COVID-19 pandemic was most sudden, but the standard diversification of PAC was slightly lower than in 2008, which might be related to the rapid policy response after the event. And last, the limitation of diversify is systematic risks. During the global financial crisis and the COVID-19 pandemic, individual stocks of index fluctuation was highly corrected. Diversified investment cannot effectively hug against the synthetic stocks, and the overall portfolio risk has significantly increased. And the industry harmonization, stocks were in the technology sector and the financial sector were both severely hit during the two crises, and the effect of cross-industry diversification was limited. The sampling notice and sampling period limitation may affect the estimated standard diversification. That's all. Thanks for listening.